Hi, my name is Nick Grantham. I'm a CPA, and today's video is going to be talking about the balance sheet, and we're going to dive specifically into the opening balance equity account that you may or may not be seeing in your QuickBooks balance sheet. You might be asking, what does this mean? Why do I have this? And we're going to dive into that in today's video. So, for starters, we want to look at a balance sheet and talk about what we're seeing when we pull this report up. So maybe you're a small business owner, you're used to going into your reports and looking at your profit and loss statement where you're seeing your business's sales and all the related expenses, and you get down to your net income number. Ultimately, that's generally what you're being taxed on. But the balance sheet is a different type of report, and that's what we're going to talk about today. So, in QuickBooks, if you go to the reports section and pull up your balance sheet, you will come up to a report that looks like this. And by default, it will typically either pull it up. Oftentimes, I see as of the most recent month, or it'll say this year to date. And so it'll basically pull it up as of today's date. Now, the balance sheet is different than the income statement. The balance sheet is not really a date range. Instead, the balance sheet is a point in time. So even though we're pulling it up and in QuickBooks we're selecting a date range, it's really just that ending date that matters, right? So in this example right now, we're seeing January 1st of 2025 through August 11th of 25. So that means that all of these numbers that we see here on our report are actually going to be as of today's date, right? So as of August 11th, 25, this is my balance in these accounts. So basically, the balance sheet is showing us our assets at a point in time, and then it's being offset on the bottom part by the liabilities and equity, right? So for assets, you're generally going to have cash, checking accounts, and you may have undeposited funds. These would be, payments that customers pay you. You've notated that you've received those payments in QuickBooks, but maybe they haven't been deposited into the bank account yet, so they're going to show up as an other current asset on your balance sheet. You may have inventory, accounts receivable, and fixed assets. That's another big one. But there are other types of assets. You may have investments and things like that on your balance sheet. But in today's video, in our sample company here, we have a checking account, a business savings account. So we've got about $2,000 as of August 11th in our business accounts here. We've got accounts receivable. So this is some money we're waiting on for clients to pay to us. We've also got a little bit of inventory and undeposited funds. And then lastly, we've got a fixed asset here. It looks like it's a truck. So we have a business vehicle. We've got that here capitalized on our balance sheet. So our total assets shows right here about 23.4 thousand. Okay. And that's going to be offset by liabilities and equity. So in other words, yes, we have that cash in the bank. Yes, we have that accounts receivable, the inventory, so on and so forth. But how did we get those items? Well, we either had equity, so we either made the money, contributed the money to the business, right? So you can see down here at the bottom, the equity section, we've got net income. So this would be like the money we've earned so far this year. But then we might have liabilities, right? So the truck, we've got that $13,000 truck we saw. Well, how did that get there? Maybe we have a loan for it, right? So see, we've got this note payable in the liability section. We've got credit cards, right? Business credit cards. We've got accounts payable. So maybe we owe vendors money. So that's really what the balance sheet is showing us. It's showing us what assets did the business have, and then what are the business liabilities and equity. And ultimately, like I said before, we'll pull this up for a certain point in time. So maybe today's August 11th, but maybe we've reconciled our books only through July, right? So instead, I want to change this maybe to last month, and that would give us a more accurate depiction of where we were at through the most recent reconciliation date. Another important thing to mention is you can pull up your books on either an accrual or a cash basis. So depending on how you file your tax return or how you like to keep track of your books and view them, you might want to switch over to the cash basis potentially. The cash basis, you'll notice, does not show accounts receivable. or accounts payable for that matter, they zero out. And that's because the cash basis is showing us basically just what cash has come in and what cash has left the bank account. Whereas the accrual basis is showing us maybe bills that we've been invoiced and we haven't paid yet, but technically they've hit the books. So in today's video, though, I really want to dive into this account down here in the equity section, and it's called opening balance equity. And many of our clients will come to us with their books. Maybe they tried to set some things up on their own. They got QuickBooks going, small business, so not a ton of activity. So they kind of felt like they could manage things. But, when we see their books, we're seeing this opening balance equity account, or maybe they're asking us why this is here. And so we want to talk more about what this is and how to zero this out, because we really don't want to see an opening balance equity balance on the balance sheet. Okay, so what is opening balance equity? Well, this is kind of QuickBooks' way of just more or less dumping a transaction into an account where we don't have it classified, correctly. So oftentimes we'll see this when new bank accounts are connected to QuickBooks that had a previous balance, or maybe a loan, or some type of note payable, note receivable, something like that was attached as well that had a previous balance, right? And so we need to recategorize that previous balance to zero this out. So when you select, so like I was saying before, if I change this to last month, so we're looking at it as of July 31st. This is showing a date range. Okay. And so I can drill down on any of these accounts. So if I select opening balance equity, it will show me just the date range that I had selected. So even though the balance sheet is at that specific point in time, when I drill down, this date range that you select in QuickBooks will then show you in the drill down selection multiple transactions. So we can see 3 different transactions that hit this opening balance equity account in the month of July. So what I really want to do is I want to figure out why this account has any sort of balance at all. So I want to see everything. So I'm going to change the report period for all dates. And that way I'm going to actually see every single transaction that's ever hit this account. And we have, it looks like 5 transactions, all in 2025. So we want to, more or less figure out why these are here, and we need to fix them and figure out where they need to actually be categorized to. So let's start at the very beginning here. So we see on February 27th, we had a deposit. So that's money coming into our business checking account for $5,000. So let's click on this. Now, I can kind of tell you right now that to me, it looks like this was potentially, and we see this a lot, but what will happen is maybe somebody starts a business, okay, and they set up their QuickBooks a couple months later, okay, so they start an LLC, maybe they're getting the ball rolling, and then they've got their business bank account, maybe they have done a few sales, and so their bank account has a certain balance, and then once they decide to create their QuickBooks, they connect that bank, but really that bank has a previous balance potentially. And so it's possible that everything that happened pre import date, so if you're not importing all of the bank history, from when the business bank account opened, you might have an opening balance. And instead of that getting categorized to sales or owner investment, it's just getting dumped into this opening balance equity account. So what I would want to do in this example is I would want to see, okay, what was this? This says bank deposit 5,000 exactly. So maybe if I look back at my bank statement, I would see, oh, this is just a mistake. This was me contributing $5,000 into my business account. And so if that's the case, then instead of this saying opening balance equity, we want to change this to an owner investment account. So maybe you're a partnership, or maybe you're a sole proprietor and you've just put the money into the business. Well, instead of opening balance equity, then we just want to change this to owner's investment, or it might be called owner contribution or owner's equity. And so we don't even have, it doesn't even look like we have an account. I can look at all our equity accounts if I scroll through here, and I have retained earnings and opening balance equity. So that's pretty much all I've got on here. So, in a sense, this opening balance equity account is kind of the catch-all for anything equity other than retained earnings. So, we just want to be more descriptive, right? So, opening balance equity, no, let's change this to, let's pretend like this was us actually putting 5,000 in to kind of start this business. So, instead, I'm going to change my account to, I'm going to call it owner investment. You could call it shareholder investment if you're, maybe if you're like an S corp, or it could be common stock or additional paid in capital if you're issuing stock, from the business to an investor or to yourself. If you're just a sole proprietor or partnership, maybe we can just call this member investment, owner investment. So, you've got, depending on what type of entity classification you are, you can title it how you'd like, but just for the sake of simplicity, I'll just call this owner investment. And I'm going to have to create this as a new account. So in this process, this sidebar wizard will pop up and it'll allow me to select, account type and account name. So I've already typed in the account name as owner investment. This is going to be a balance sheet account, but it's going to be not an asset account, but instead an equity account. So in the detail type, you could really, there's all kinds of different options here. You could, this is really kind of an owner's equity account. But see, if you're a partnership, you could say that it's partner's equity. We've got a lot of different options. I'm just going to call it owner's equity under the detail, and I'm going to hit save. And where it says received from, I could even type my name in here if I wanted to. So I could type in Nick Grantham, and I could add myself in here if I wanted. I could add description. I could say this is like my initial investment, into my LLC or something like that. And so I can then hit save and close. And now this transaction, once we refresh, this should fall out of the opening balance equity account. So now we're down to 4 transactions. If I go back to my balance sheet and if I run it and refresh it, now when I scroll down to the bottom, you can see here, okay, under the equity section, retained earnings is nothing because this is the first year of our business. Okay. Net income is showing a loss. So I suppose maybe before this was categorized as a deposit of income. I've updated it to an owner investment. So we're showing that we have a little bit of a loss for so far for 2025 through July, but we still have this negative opening balance equity that we need to figure out what to do with. So let's go back in here. Let's drill back in. I'm going to change this to all dates again. So we're looking at everything. All right. So this next balance is so one thing I wanted to mention here too is these positive balances would indicate potentially like an asset or income of some sort. These negative balances are typically going to be a liability of some sort. So we'll see on this next one here. Okay, so yeah, perfect. This right here is the truck. Okay, so see, we've added a truck here, and it didn't know like what the other side of that entry was, so it just put it to opening balance equity, right? So a truck somehow got recorded on the books. So typically the other side of this is either going to be money leaving your bank account. Maybe you purchased it beforehand, so in that case, maybe it's an owner investment. So if money didn't leave the business bank account, instead you bought the truck a year before you started the business. So maybe this is you contributing your truck to the business. So then that would be an owner investment, or maybe this is a loan. Maybe you went out and you put some money down, but this is actually supposed to be, maybe this is the down payment. Maybe the truck's $60,000. Maybe this is the full cost, and this is all notes payable. In today's example, though, we're going to assume that this is a down payment and we have another transaction that is the note payable piece of that. So the truck is actually potentially understated on the balance sheet. So let's pretend in this example that we paid cash down for this vehicle, kind of right as we were starting our business. And so we didn't even have our business bank account set up yet. So this is a cash down payment, and we need to reclassify this as a down payment. So We have here the original cost of the truck is what it's saying, $13,495. That's the down payment. So instead of this saying opening balance, I'm going to change this description to down payment, and I'm going to pretend this is a Ford F-150. And we can even say like VIN number and put 4 digits here, for example, if we're trying to be more descriptive. And then I'm going to copy this here on my second line as well. And instead of opening balance equity, this was me as the business owner. This was me putting in, cash and putting a down payment down before I had my business bank account like fully set up. So instead, we need to fix this to show that this was really an owner's investment. This was me putting cash in. It never got in QuickBooks, but it was a business vehicle. It was my investment buying that down payment piece for cash. So I'm going to hit save and close. This is going to now remove this 13,000 from our opening balance equity. And if we go back to the balance sheet, you'll see again we have this original cost for this truck of 13,000. And then down here, we've got a notes payable for 25,000. We'll come back to this in a moment. And then we've got our opening balance equity, which is now negative 14,000. Okay, and we're going to keep working down the list. So we're going to come back to this. I mentioned earlier with the vehicle, we're going to update and add that piece of the vehicle that was financed. But for now, we're going to just move on to this next deposit here. So let's see what this is. Okay, so we can see here it's the savings account. When we looked at the balance sheet earlier, we had a checking and savings account. And this is $800 and it just says opening balance. So this is kind of a similar situation potentially to the first example. It looks like maybe we connected our savings account to QuickBooks after it had already been set up and some cash had been deposited inside it. So if this is simply just the initial cash contribution that was in that bank account when it became a business bank account, then this is very similar to option one. Instead of opening balance equity, we just need to change this to owner's investment again. So the first 3 examples have all been the same. We're just reclassifying these as owner's investment because this is cash that myself as the owner put into these business accounts, and then once they got connected to QuickBooks, the cash was already there. So we kind of missed a step, and so that's why we're reclassifying those in that way. All right, the next one is a negative balance. Okay. Yeah, perfect. So this is kind of the inverse and opposite of what we looked at with the truck. So this, instead of adding a fixed asset to our books, this is actually adding debt to our books, right? So you can kind of see that this journal entry is opposite. We've got the credit to the loan payable. So that's adding the liability to our balance sheet. And then right here, opening balance equity, we didn't know like what was the asset to offset this loan, right? So maybe for example, I went out and I got a loan for some type of equipment, right? So I've got my truck, but I had to, I needed a trailer, right? I'm doing construction work and I needed a trailer, and I didn't put any cash down. I just went out and got a loan for a trailer, and the loan got recorded because in QuickBooks there are ways where you can connect potentially your loan in a similar manner that you would connect a bank account, but we didn't get the other side of it, right? So this time we've got the loan on there, but we don't have the trailer as the asset. So instead of this being opening balance equity, we're going to pretend this was a loan for a trailer. So I'm going to add a fixed asset. So similar manner, we're going to add a new account. This is going to be a fixed asset account, and there should be an equipment option in here, or vehicles. I think machinery and equipment makes more sense. And so we're just going to hit save. And then under description, I'm going to obviously add some description here. I'll say this is my loan for trailer. Okay. And maybe under the fixed asset, I'll just call it, trailer like this. And if I hit save and close, what's going to happen now is we're, again, going to clear something out of this opening balance equity account. We're down to one last item. If we look at the balance sheet and refresh this again, we will now see a trailer under our fixed assets. So now we have both a trailer and a truck. And our 4,000 loan is here. So see this, here's the 4,000 loan, and then here's the 4,000 trailer. So you can kind of see now, instead of them being both down here in the equity and liability side, now they're on the fixed asset and liability side. So this makes more sense. And now we've just got one more transaction down here, and I can already tell you it has something to do with this notes payable of 25,000. And see, this is a negative 25,000. So let's drill back down. This is our last item. And here we go. This is very similar to the one we just looked at for the trailer example. This is another liability that got just basically plopped onto the balance sheet, and the debit account, was unknown, so it just kind of got, you know, plopped into opening balance equity here. So, what we're going to do in this example is we're going to pretend that this is the loan piece, the financed piece of that truck we were talking about. So we put that 13,000 down, but we also went out and got a note payable on the truck for 25K. So what we need to do, we need to reclassify the debit side of this entry to the fixed asset, right? So the truck account already exists, and it's there's a truck account, but in this example, it's actually in a sub account called original cost. That's fine. You can do that either way. We could have, if we wanted to avoid sub accounts and just make it super simple, we could have had everything categorized to a parent account just called truck. But that's why, because it was already set up this way, I'm coding it here to original cost truck. And this is going to be the financed portion for the Ford F-150. And I made up a VIN number earlier. I think it was like 7899 or something. I'm not quite sure if that's what it was, but I'm going to pretend that that's what it was. And now, again, what we're doing, we're moving this debit entry out of opening balance equity, and instead it's being shifted up to the fixed assets side of the balance sheet. And now when I hit save and close, I will show you how this updates our financials. So I'm going to refresh my balance sheet once more. Let's start at the bottom, actually. So down here, opening balance equity is now gone. So we don't see that account. That's great. That's kind of what we want to see. So now we just have three equity accounts. We have retained earnings, which is zero because this is our first year of business. We have net income, which is a small loss for the year so far. And then we have the money that we as the, business owner started the business with. We put the money in for the truck, we put some cash into these business bank accounts to get started. So we've got our owner investment, we've got our little bit of a loss, and that's pretty much the activity we have so far this year. Now, if we go to the very top, back to the assets, you'll notice the truck is now at a much higher value, and this makes more sense, right? So I don't know where you're going to get a truck for $13,000 in 2025. Maybe it's really old and used, but this seems fairly inexpensive actually nowadays. But this is much more reasonable for maybe a used Ford F-150 you bought to get your business started. And so you put 13K down, you finance 25K. So here is our full purchase price. It's important on the balance sheet, in the fixed assets section, we need the full price, right? So a lot of times we see clients, they put a down payment down, they finance a portion, and somehow that finance portion gets forgotten about, and it's not put on the books correctly. So it is important, we need both halves of that. We need both pieces. We need the down payment and we need the finance portion. So we have that updated. We have our trailer. So you can see now our assets have increased from when we first started. So we've got our bank balances, we've got some undeposited funds, and then we've got our fixed assets. And then the offset to that, we have our liabilities. We have a note payable for the trailer. We have a note payable for the truck. And then way down here, we've got some money we put in as the owners. So I hope this video was helpful. I really just wanted to focus on the opening balance equity. We have a lot of clients that are confused why that's even on their books. And most of the time it has to do with when you're setting up your QuickBooks initially, or when you're connecting new accounts or new, lines of credit, if you're adding credit cards to the books, if you're adding those sorts of things to the books, and it's not on day one, it's maybe a few months after those accounts have been opened, then they have an opening balance. And so we need to reclassify that opening balance, whether it be, maybe it was a personal, maybe you're a sole proprietor, and so you were using a personal card. And so the opening balance on a credit card was personal, so maybe that needs to be categorized against owner draw. Or maybe it's like the example we went over where the opening balance is truly just money that you put in the account as the owner to get the business started. And when you added that to QuickBooks, we just needed to reclass that to make sure we're getting everything set up from day one. So leave a comment below if you have any questions, or if anything wasn't clear, or maybe if there's anything else I could explain further. Thanks again for joining in and watching this video. If you found this helpful, please consider giving us a thumbs up and subscribing to the channel. We often will release podcasts with guests in different industries in our area. We're a CPA firm, so we see a lot of different industries. A lot of different clients. We help with their QuickBooks. We can help you clean up your QuickBooks or with bookkeeping if you're interested. So please do reach out. Thanks again, and have a great day.